Hi everyone, welcome back to our channel. In today's video, we're going to be talking about analyzing year-over-year trends, a critical component in measuring growth and success. Year-over-year trend analysis is a comparison of data from one year to the same period in the previous year. This analysis is essential in tracking growth or decline in performance, identifying opportunities and threats, and determining business strategies. Let's take a look at a few examples. First, let's consider a retail business. Retail businesses sell goods or services to consumers, and the performance of a retail business is typically measured by its sales revenue. Therefore, year-over-year trend analysis of sales revenue is a critical component in measuring the growth or decline of a retail business. Let's consider an example of a retail business that sells clothing. Suppose the business had sales of $100,000 in 2020 and $120,000 in 2021. To calculate the year-over-year growth rate, we would subtract the sales in 2020 from the sales in 2021 and divide the result by the sales in 2020. In this case, the calculation would be divided by $100,000 equals 0.20, or 20%. This 20% growth rate indicates that the retail business is expanding, and the management team should evaluate the factors that contributed to the growth and consider investing in strategies to maintain or accelerate growth. However, it's essential to consider external factors that might impact the year-over-year trend analysis. For example, if the retail business had a significant sale or promotion in 2021 that it didn't have in 2020, the sales increase might not accurately reflect the business's actual growth. In such cases, it's crucial to adjust the data for seasonality or promotions to get a more accurate picture. Furthermore, it's crucial to analyze the year-over-year trend of different product lines or categories within a retail business. For example, if a clothing retailer had an overall growth rate of 20%, but one of its product lines had a decline in sales, this decline could indicate a problem that needs to be addressed. The management team could investigate why that particular product line is not performing well and take corrective action. Second, let's consider a technology company. Let's assume that the technology company in question had a net income of $5 million in 2020 and $4 million in 2021. The year-over-year growth rate would be calculated as follows: divided by $5 million equals minus 0.20, or minus 20%. This negative 20% growth rate indicates that the company's net income has declined by 20% from the previous year. This is a concerning trend for the management team, as a declining net income can signal underlying issues in the company's operations, sales, or market conditions. To identify the root cause of this decline, the management team should analyze the factors that contributed to the drop in net income. Some possible reasons could be: 1. Decreased sales. The company may have experienced a decline in sales due to increased competition, changes in customer behavior, or economic conditions. The management team should conduct market research and evaluate the company's sales strategies to identify areas for improvement. 2. Increased expenses. The company's expenses may have increased due to factors such as higher salaries, increased production costs, or investments in research and development. The management team should review the company's cost structure and identify opportunities to reduce expenses without compromising quality. 3. Changes in market conditions. The technology industry is highly dynamic and subject to rapid changes in market conditions. The management team should stay up to date on industry trends and adjust the company's strategy accordingly to stay competitive. Once the management team has identified the root cause of the decline in net income, they should take corrective action to address the issue. For example, they could implement cost-cutting measures, restructure the sales strategy, or invest in new products or services that have higher profit margins. It's important to note that year-over-year trend analysis is not a one-time exercise. Companies should conduct this analysis regularly to track their performance and adjust their strategies as needed. By using this analysis to identify opportunities and threats, companies can make informed decisions and stay ahead of the competition. Year-over-year trend analysis is not just limited to financials. Year-over-year trend analysis is a versatile analytical tool that can be applied to any field, not just limited to financials. In fact, it's an essential tool for measuring growth or decline in performance and tracking progress over time. For instance, in healthcare, year-over-year trend analysis can be used to track patient outcomes. Suppose a hospital had 100 patients with a certain condition in 2020, and 80 of them recovered fully, while 20 had complications. In 2021, the hospital had 120 patients with the same condition, and 90 of them recovered fully, while 30 had complications. By analyzing the data, we can see that the recovery rate improved from 80% in 2020 to 90% in 2021, indicating that the hospital is providing better care and treatment to its patients. In education, year-over-year trend analysis can be used to track student performance. Suppose a school had 500 students in 2020 and 400 of them passed their exams with a grade of B or higher, while 100 failed. In 2021, the school had 550 students and 450 of them passed their exams with a grade of B or higher, while 100 failed. By analyzing the data, we can see that the pass rate remained the same at 80%, but the school is growing in size, indicating that the school is maintaining the same level of academic excellence. In social media, year-over-year trend analysis can be used to track user engagement. Suppose a social media platform had 1 million active users in 2020, and the average time spent on the platform was 20 minutes per day. In 2021, the platform had 1.2 million active users, and the average time spent on the platform was 25 minutes per day. By analyzing the data, we can see that the user base grew by 20%, and the engagement rate increased by 25%, indicating that the platform is becoming more popular and engaging to its users. In all of these fields, year-over-year trend analysis is a powerful tool for tracking growth or decline in performance. It provides a clear picture of progress over time and helps identify opportunities and threats. By analyzing the data, we can identify areas that need improvement, adjust our strategies, and take corrective action. When analyzing year-over-year trends, it's essential to consider the external factors that might impact the data, such as seasonality, economic conditions, industry trends, and competition. Year-over-year trend analysis is a powerful tool for measuring growth or decline in performance, but it's essential to consider the external factors that might impact the data. By taking these external factors into account, we can get a more accurate and meaningful picture of the trends we're analyzing. One external factor that we need to consider when analyzing year-over-year trends is seasonality. Seasonality refers to patterns that occur at the same time every year, such as holiday shopping in November and December or back-to-school shopping in August and September. These patterns can have a significant impact on year-over-year trends, and failing to account for them can result in misleading conclusions. For example, let's consider a company that sells pool supplies. If we compare their sales from June 2020 to June 2021, we might see a decline in sales, which could be interpreted as a sign of declining performance. However, if we take into account that sales of pool supplies tend to peak in the summer months and decline in the winter months, we might see that the decline is actually a seasonal pattern that occurs every year. In this case, it would be more appropriate to compare the company's sales from June 2021 to July 2020 to get a more accurate year-over-year trend analysis. Another external factor to consider is economic conditions. Economic conditions, such as inflation, interest rates, and unemployment rates, can have a significant impact on business performance. For example, if we're analyzing a company's sales from the year 2020, we need to consider that the COVID-19 pandemic had a significant impact on the economy, which could have affected the company's sales. Industry trends are also an important external factor to consider. Every industry has its own trends and cycles, and failing to account for these trends can result in misleading conclusions. For example, if we're analyzing the year-over-year trend for a company that operates in the technology industry, we need to consider that technology trends change rapidly. A product or service that was in high demand last year might not be in high demand this year due to the emergence of new technologies. Finally, competition is an external factor that can impact year-over-year trends. Changes in the competitive landscape can have a significant impact on a company's performance. For example, if a company's sales are declining year-over-year, it might be due to increased competition from new entrants in the market. In conclusion, year-over-year trend analysis is a powerful tool for measuring growth or decline in performance. It's essential to use this analysis to track progress, identify opportunities and threats, and determine business strategies. It's also critical to adjust the data for external factors that might impact the analysis. That's it for today's video. If you found this video helpful, give it a thumbs up and hit that subscribe button for more videos on data analysis. Thanks for watching, and we'll see you in the next one.